Alimentation Couche-Tard is not only a recession-proof stock, but they may be one of those rare stocks raking in the profits during economic downturns. Fasten your seatbelts, folks. This is going to be a good one. Alimentation Couche-Tard has been in the convenience store business since 1984, and in a very big way, as they have roughly 14,400 stores in 25 countries, and they are employing more than 128,000 folks to keep that all afloat. These stores operate under many huge names like Couche-Tard, Circle K, Holiday Inn Go, Bigfoot, and Max. When we talk about recession-proof stocks, this is one of the more popular ones that will come up in that conversation. They may have larger markups than traditional grocery stores, but they have the convenience aspect. Paying a little more for milk or bread on the way home can end up being cheaper than making an additional trip to the grocery once you add in the extra cost of gas. And heck, in most of these stores you can get the gas there too. Also, their products do tend to be essential, and that means even in economic downturns, the demand does not really go away. This works in their favor big time. One last consideration is that a company like this is very expansionary, and often in these downturns, they can buy some of their rivals at a much cheaper price. So this also helps to feed their overall expansion goals. For those of you concerned with ESG, Alimentation Couche-Tard was recently recognized as a 2023 top-rated ESG performer by Sustainalytics. They also received a bronze medal from EcoVadis as they had exceeded the industry ESG standards in all categories. Join the conversation. Let us know in the comments if you have ATD in your portfolio. Your participation is well appreciated. Don't forget to like and subscribe to stay up to date on future content, and a huge thank you for that click. It is just fine being called a recession-proof stock, and having a good-looking earnings call goes a long way to prove this. The recent share buybacks announced back in July also adds to this pile of proof. However, I am not so concerned about that pile, and it can pile as high as it wants, but the real proof will be found not in a pile, but rather in their fundamentals. As usual, we are going to need to get our fundamental sniffing sleuth hats on and call on our good old buddy, Mr. Math. We will, once again, start with a little surface data to get the numbers started. So they have a market cap of $71.61 billion, and they have a pretty average beta of 0.92. Their earnings per share come in at 4.16, and they have a price to earnings ratio of 17.30. If we look at the average of their peer group, that comes in at 14.9. Just looking at their peer group, we can see that, well, Empire has 12.4, Metro comes in at 17.1, and good old Loblaw is a little bit higher. They're up there at 18.0. They're not really that out of line with what we are seeing here. Let's take a look at their price to book ratio. That comes in at 4.0, and those same peers have an average of 2.7. Yes, you may expect them to be slightly overvalued on this data alone, but these numbers may be inflated with their continued expansion push. They have added more than 2,000 stores since the last time we peeked in on their fundamentals, and that was roughly about a year ago. Lastly, for the surface data, we do have a return on equity, and it's nice, 23.76%. I really like what we have seen thus far, so let's peel back another layer and take a good old gander at their cash situation. Their revenue comes in at $68.82 billion, and they've got earnings of $3.05 billion. And those earnings, they're projected to grow by 6.32% per year over the next 5 years. In fact, those earnings actually grew 9% if you look at just the last year alone. Their profit margin comes in at 4.4%, and that's not too shabby. They have a free cash flow of $2.89 billion, and their operating cash flow comes in at $4.64 billion. Let's, of course, figure out that fair value. So their current value comes in at $74.50. Using a discounted cash flow model, we do get a fair value of, well, holy banana bread, $113.32. That actually puts them undervalued at 34.3%. When we were looking at the PE and the price to book ratios, it almost looked like they would be overvalued. But as I said, they are expanding, and that growth inflates ratios such as those two, and this really makes me think they are not done yet by any means. So let's dive in deeper and take a look at the returns that Alimentation Couche-Tard has been putting on the table for us. When it comes to dividends, they don't have a huge yield. It only comes in at 0.752%. It's paid out quarterly in the amount of 14 cents per share. The payout ratio on that is 12.95%. It goes without saying that this is not really a dividend stock, and that is perfectly fine, as this is a strong growth stock. Somewhere in the future, when the growth does begin to taper down, you can more than than likely expect to see the dividend yield begin to perhaps creep up a wee bit. Looking at their return on investment on the 3-year, their price rose from $43.17 to $74.12. That's a return on investment of 71.69%. Factor in the dividends, we do get a total return of 74.82%. That's pretty darn good. Let's look at the 1 year. On the 1 year, their price rose from $56.99 to $74.12. That's a return on investment of 30.06%. And factoring in the dividends once again, we get a total return of 31.04%. When we focus on this year, the year to date, their price did rise again from $60.39 to $74.12. That's a return on investment of 22.74%. That brings us in with a total return, once we add in those dividends, of 23.43%. These returns are nothing short of awesome. They reflect a company that has ignored a bear market and will ignore a recession when we get one. As much as we want to call this one a winner, we still have one more layer to peel back, and we do need to take a look at their debt. They have a total debt of $6.49 billion, and their total equity comes in at $13.28 billion. That makes their debt to equity ratio 48.8%. Holy banana bread. I love this number. And it is even more amazing when you consider that their debt to equity ratio was like at 101%, and that's just 5 years ago. They do also have some cash and cash equivalents adding up to $1.96 billion. This is pretty good. Let's take a look at that short term. On the short term, they have assets of $6.70 billion, and their liabilities come in at $5.66 billion. That's not too bad. What about the long term? Their assets come in at $23.63 billion. Liabilities come in at $11.38 billion. Once again, that's not too bad. I mean, I do like to see the short-term assets beat the long-term liabilities, but that's not going to happen in this case. And with the numbers we've seen, I'm okay with that. These are overall very good debt numbers, and it goes without saying that there is no concerns with debt as far as I am concerned. They have debt coverage from their operating cash flow, and their EBIT, that earnings before interest and taxes, more than covers the interest on the debt. So I do have to ask, what is my final verdict? Recently, I did a tier ranking for Canadian stocks for the channel members, and Alimentation Couche-Tard was one of the few stocks that I ranked in the God tier. This deep dive has only cemented that decision. If you do want to see that tier list video, and that was a fun one, just click on that little join down by the like button, and that'll allow you to join the channel membership, and you can watch all of the previous videos when you do join. This is a company that most investors should be taking a hard look at. They are an almost perfect total return stock, with most of the return coming from their growth. Sure, it would be nice to see a little more in the dividend department, but that is not even close to a deal breaker. For a pure passive income investor, this is probably not a stock for you, though it could be a nice circle the wagon core stock if you just want to have an investment flashing green when everything else is down into the red. If you are a growth or total return investor, this is hands down a stock you want to look at. It is a growing recession-proof stock without the burden of bad debt. Yes, they do have debt, and they will continue to have debt as that is part of the growing game. They are, though, managing it well, and it's really not an issue in my opinion. If you love what you have heard today about Alimentation Couche-Tard, be sure to throw in a heaping helping of due diligence, because it is your hard-earned cash you are about to throw on the table, and you can never be too careful with your money nowadays for sure. Keep the learning going. Watch my video on yield max ETFs linked on the left, or test YouTube's recommendation skills by checking out the video on the right. Your choice will decide the winner, and I will see you as always in the next video.